Things are improving quite considerably in the American labor markets. We're seeing that the unemployment rate is increasing, but that's for a reason. A good reason is that the participation rate is increasing dramatically. Over the last 6 months, it has been we've seen a very large increase in the number of Americans that are actually seeking a job. So the participation rate is at last increasing and actually quite dramatically. So we have to go all the way back to 2000 to see a similar 6 months period with an increase of this size. Furthermore, we see the so-called NFIP, Small Business Confidence hiring plans, if not going through the roof, it's at least going to a level that is comparable to what we saw before the financial crisis. We also see the quit rate, which has increased quite dramatically. So the quit rate means how many are voluntarily leaving their job for something else. And this is also what you see in periods with very high job security and a tighter labor market, you might say. China is also improving. The housing starts are improving quite dramatically. We're seeing prices in house prices in China are still rising. That was what you would be afraid 6 months ago if prices would begin to decline and it would lead into a deflationary pressure on the Chinese economy. It looks like we can avoid that for the time being and probably for the next 12 months at least. So for the time being, also because we're seeing new yuan loans or credit growth in the Chinese economy, things are definitely improving from here. So the countries that are going to benefit from a stronger China that's Australia and Brazil. Australia because they're producing a lot of the metals in demand from China, and Brazil because they're producing a lot of the energy and other commodities in demand from China. And Brazil is particularly in a bad situation currently because of the political turmoil in the country, and also because of the corruption and all that going on. They could surely need some help from a stronger China. Emerging markets have been the most hated asset class in the past couple of years. We've seen record outflows from the emerging market shares, especially in the end of 2015, and that probably marks the apex or culmination of this horrible development for emerging market shares. What we're seeing currently in 2016 is a relative outperformance. Emerging market shares are still very attractively priced with a price earning of about 14, whereas MSCI World is priced about 20. So still they're a lot cheaper than MSCI World, and that could ultimately lead to quite attractive returns for investors in the asset class going forward.